Hatem Dhiab. He's managing partner at Gerber, Kawasaki Wealth and Investment Management. Thanks so much for joining us this afternoon.
Thank you, Jacqueline. Good to be on.
So I wonder what you make just of what we're seeing today. I mean, I mentioned a couple of the movers out there, the Taiwan Semiconductors, quite a lot of momentum behind that stock this afternoon. But the gains that we're seeing on the NASDAQ and sort of coming in this month where things have been fairly flat in the month of January so far.
Well, we're just getting started right this year. I think seeing earnings and seeing upgrades and positive outlooks is really what the market is looking for. We're just getting started in this earnings season. Bank earnings were okay. So I think what happened last year, which with the tech sector that really drove the market, if that continues to be the case this year, then we should see some positive momentum. Do
you think that it will be the catalyst this year?
History suggests that, you let your winners ride. We have this whole AI revolution that is happening, and I think a lot of these tech companies in the US are really benefiting tremendously from it. So you spoke about TSM, but like NVIDIA's and Apple and Meta are going to be big benefactors from this as well.
So if you were sort of in the position to, maybe add it to those particular companies right now, would you be doing so or, waiting for a particular moment, or what do you think?
We're looking at, there's a lot that was said about how these stocks have driven the market and, the 60% of the return last year. Mm-hmm. However, if you think about earnings growth or what kind of earnings that these companies will generate, and I'm talking about the Magnificent Seven, they're going to generate about 50% of all of the S&P earnings. So if you're thinking about investing in companies that are growing earning, you have to own these companies and you have to buy them if you don't.
Are there particular ones among them that you think are special? You talked about Apple there as one of them, but we have heard from a couple of analysts that cover the stock that have downgraded Apple recently with some concern around the iPhone sales sort of flattening out in terms of growth.
Yeah. We like Apple into this. Apple hasn't done that well compared to the other Magnificent Seven. And I think with this Vision Pro coming out, it's not going to be a big product from the onset as far as revenue, but this is going to launch a brand new spatial computing device that can create a brand new ecosystem of products and apps and things that can be done. So I think the excitement that's going to come from this product is going to really create some nice momentum for the stock going forward.
And what about, those are, the real technology companies that you're thinking about, but what about Tesla, which has, found itself in that Magnificent Seven lot as well? What are you thinking about Tesla these days?
As you know, we've been very positive on Tesla for many years. Unfortunately, all these price cuts have really hurt the outlook for the whole EV space and the stock itself. I think cutting margins or hurting margins with these kind of price cuts that nobody knows when are going to happen has been really detrimental to the stock. And then we have the Elon risk, which, Elon is as big of an innovator and a genius he is, what he's asking for with this, 25% of stock is really kind of in poor form. So I think that's really getting investors really nervous.
Yeah, that was Elon talking about wanting to have a bigger controlling stake in some of the more tech-focused parts of Tesla.
Yeah, and the way he said it is he said if he doesn't get the 25%, he will be developing products outside of Tesla. So he's almost blackmailing investors or Tesla investors, shareholders, to get more shares, even though his current comp plan is still in litigation in Delaware. So I think it was just a poor form. I think there is a better way of doing that, or at least a better way of asking for more comp. He currently owns almost 20% of Tesla. But that's really definitely weighing on investors, and we're seeing that in conversation we're having on a daily basis.
When you're looking at this earnings season as a whole, it sounds as though, expectations have come down quite a bit leading into this. How do you interpret that?
You know, it's crazy. The expectations have gone down quite a bit, actually, almost 6%. I think we have a 1% growth that's expected for year over year for this earnings season. That may be actually positive. We may have some nice surprises. The economy, as you said, in the U.S. really hasn't fallen apart. We see a lot of positive momentum. Consumers still spending. Enterprise spending is coming back. So I think having a lower expectations may actually bode well for positive momentum.